Most people believe markets react to bad news. That belief is comforting and wrong. Markets don't move because something bad happens. They move because something changes before most people notice it. By the time the headline hits your screen, the price has already adjusted. By the time panic feels justified, the positioning has already shifted. This is why crashes feel sudden. Not because they are random, but because the risk was invisible to those watching the wrong signals. Investors tend to focus on outcomes. Price up, price down, green candles, red candles. Professionals focus on pressure, where stress is building, where assumptions are becoming crowded, and where a small change can trigger a large reaction. That's the uncomfortable truth about markets. The biggest moves rarely start with obvious news. They start when expectations quietly drift too far in one direction. Today's move is a perfect example of that dynamic. Nothing broke in an hour. No system suddenly failed. What happened was a repricing, fast, mechanical, and unemotional. And if you only look at the price, it feels chaotic. If you look at the structure underneath, it becomes understandable. That's what this analysis is about. Not telling you what to buy, not telling you what to believe, but helping you see what the market was reacting to before the reaction happened. On January 29th, 2026, precious metals experienced a sharp intraday decline following a period of unusually strong gains earlier in the month. Gold prices had been trading near record levels, reaching the area around $5,550 to $5,600 per ounce during the Asian and early U.S. sessions. Within the same trading day, prices declined rapidly, falling to approximately $5,150 to $5,200 per ounce before stabilizing. The move represented a single-day decline of roughly 7 to 9%, depending on the intraday reference point. Silver showed even higher volatility. Prices had recently reached levels near $120 per ounce, marking a multi-decade high. During the January 29th session, silver prices dropped to the $108 to $110 range, a decline of approximately 9 to 11% within a short time window. The speed of the move was notable. Most of the price adjustment occurred within roughly 1 hour during U.S. market hours, coinciding with high liquidity and active futures trading. Trading volumes increased significantly during the decline, indicating broad participation rather than isolated transactions. Compared to the previous week, both metals were still substantially higher despite the sell-off. Gold remained sharply positive on a month-to-date basis, and silver, even after the decline, continued to show one of its strongest monthly performances in decades. No exchange halts were triggered, and trading across futures, options, and spot markets remained orderly. Price discovery continued throughout the session, with volatility gradually declining after the initial sell-off. Importantly, no single economic release, geopolitical event, or emergency policy announcement occurred at the exact moment of the decline. The move followed a period of elevated positioning and rapid appreciation in prices earlier in January. In summary, January 29th was characterized by a sharp intraday reversal in gold and silver prices, high trading volume and elevated volatility, a fast repricing occurring within normal market functioning, prices remaining well above levels seen earlier in the month. This section establishes what happened, without assigning motive, blame, or forward-looking conclusions. The importance of the January 29th move lies less in the price decline itself and more in how the decline unfolded. Rapid price movements in liquid markets rarely occur because of a single headline. They emerge from interacting mechanisms that amplify one another once a threshold is crossed. The first mechanism is positioning. Leading into the sell-off, both gold and silver had experienced sustained upward momentum. Such conditions typically attract increased futures participation, options activity, and short-term speculative exposure. As positioning becomes more concentrated, markets become more sensitive to marginal changes in funding costs, currency moves, or liquidity conditions. The second mechanism is price elasticity under leverage. Futures and options markets require continuous margin maintenance. When prices move sharply, margin requirements adjust automatically. This can lead to forced position reductions that are mechanical rather than discretionary. These actions are not judgments about value. They are risk control responses embedded in market structure. The third mechanism is correlation convergence. During periods of stress or rapid repricing, assets that normally move independently can begin to trade together. Gold and silver often share directional bias, but silver typically exhibits higher volatility due to its dual role as both a monetary and industrial metal. When both decline simultaneously and rapidly, it suggests the influence of macro-level forces rather than asset-specific news. What makes this type of move significant is its second-order impact. First-order effects are visible immediately: price declines, higher volatility, and increased volume. Second-order effects appear afterward: changes in risk tolerance, reduced leverage, and tighter liquidity conditions across related markets. These second-order effects matter because they can influence market behavior beyond a single session. After sharp repricing events, participants often reassess position size, time horizon, and risk exposure. This can temporarily suppress momentum even if the broader trend remains intact. Another key implication is information asymmetry. Markets incorporate information continuously, not sequentially. By the time price moves become visible to most observers, adjustments by large participants have often already occurred. This does not imply intent or coordination. It reflects differences in speed, scale, and access to liquidity. Finally, moves of this magnitude serve as stress tests. They reveal where liquidity is deep, where it thins out, and how quickly markets can transition from trend-following behavior to risk reduction. These transitions provide valuable information for understanding market resilience and vulnerability. In short, January 29th was not important because prices fell. It mattered because it showed how quickly market structure can amplify pressure once conditions align. Understanding that process is essential for interpreting what comes next, without relying on headlines or emotion. When markets move sharply, the natural instinct is to search for a single reason. The more useful approach is to compare the setup, not the headline, to prior periods where conditions created similar stress. A comparable backdrop is any moment when three ingredients overlap: a strong, extended trend, prices rising quickly over weeks; crowded positioning, more leverage, more short-term participation; a catalyst that changes risk perception, rates, currency, policy uncertainty, or liquidity conditions. We've seen that mix before. 2008. Precious metals did not move in a straight line. Even assets viewed as safe experienced sharp drawdowns when liquidity became the dominant constraint. The mechanism wasn't that gold failed, but that leverage and forced selling mattered more than long-term narratives in the short run. 2011, silver. Silver experienced an extreme upside move followed by a fast decline. The key lesson wasn't about the direction afterward. It was that silver's volatility can accelerate rapidly when positioning becomes one-sided and margin dynamics tighten. March 2020. Gold initially sold off during the broad risk event. The key point is not the later recovery, but the earlier phase. When liquidity is scarce and portfolios are being rebalanced, even defensive assets can be sold to raise cash or meet margin requirements. Those episodes share something with January 29th. The move is often less about value and more about structure. Structure means leverage sensitivity, liquidity depth, and how quickly traders shift from trend participation to risk reduction. What is different this time? The market environment in 2026 is shaped by elevated attention to rates, currency dynamics, and policy signaling, which can shift capital quickly across asset classes. Silver's dual character, precious and industrial, can make it react differently depending on whether the market is emphasizing monetary conditions or growth/industry expectations. The right takeaway is not "this will repeat." It is sharp repricing events tend to occur when positioning and market structure become fragile, regardless of the long-term story. History doesn't tell us the outcome. It helps us recognize the conditions that make extreme moves more likely, so we respond with process, not emotion. Professional analysis is not about predicting a single outcome. It is about mapping plausible paths and understanding what would need to change for each path to unfold. Below are three scenarios based on observable conditions, not conviction. Bull case: trend resumes after repricing. If recent volatility represents a structural reset rather than a regime shift, then prices could stabilize and eventually resume strength. For this to occur, several conditions would need to align. Volatility compresses following the repricing, indicating that forced selling and position reduction have largely run their course. Liquidity normalizes, with bid-ask spreads tightening and volume returning to more typical levels, rather than stress-driven spikes. Macro signals remain supportive, meaning no material shift toward tighter financial conditions than what markets have already priced in. Investor behavior changes from reaction to allocation, with participation shifting away from short-term leverage toward longer-term positioning. In this scenario, the January move would be interpreted as a mechanical correction within a broader trend, driven by positioning and market structure rather than a deterioration in underlying conditions. Importantly, this outcome does not require new bullish news. It only requires that conditions stop worsening. Base case, consolidation and reassessment. The base case in many professional frameworks is often the least dramatic. If volatility subsides but uncertainty remains elevated, then markets may enter a period of consolidation rather than immediate continuation or collapse. Characteristics of this environment typically include wide but stable trading ranges as buyers and sellers recalibrate expectations, lower momentum with fewer directional follow-through moves, selective participation where capital becomes more cautious and position sizes shrink, heightened sensitivity to data as markets look for confirmation rather than narrative. In this scenario, the January repricing acts as a pause point. The market absorbs information, adjusts risk exposure, and waits for clarity from macro indicators such as policy guidance, inflation data, or currency movements. This path is often frustrating for short-term traders, but is common after sharp repricing events. It reflects indecision, not weakness. Bear case, structural shift in conditions. The bearish scenario requires new information or a sustained change, not just continuation of recent volatility. If financial conditions tighten further, then the recent move could mark the early stage of a broader adjustment. Signals consistent with this scenario would include persistent strength in the US dollar accompanied by rising real yields, deterioration in liquidity, where rebounds fail quickly and volume increases on down moves rather than up moves, policy signaling that materially alters rate expectations, rather than simply reinforcing what markets already know, reduced risk tolerance across asset classes, indicating a broader de-risking phase rather than an asset-specific event. In this case, the January decline would be less about position cleanup and more about repricing long-term assumptions. Notably, this outcome does not depend on sentiment turning negative. It depends on conditions changing in a durable way. Putting the scenarios in context, these scenarios are not forecasts, they are decision trees. The purpose is not to guess which one will occur, but to recognize which signals would validate or invalidate each path. Markets rarely announce which scenario is playing out. They reveal it gradually, through behavior, not headlines. When volatility rises, the temptation is to watch prices more closely. Professionals do the opposite. They watch inputs, not outcomes. Here are the indicators that matter most to me right now. PMI's US dollar index, DXY. The dollar sits at the center of global liquidity. Movements in precious metals often coincide with shifts in the dollar, particularly during periods of repricing. I'm not looking for day-to-day fluctuations. I'm watching trend behavior. Does strength persist, or does it fade quickly? Are moves being confirmed by volume and follow-through? Sustained dollar strength would suggest tighter financial conditions. A rollover would indicate pressure is easing. 2. Treasury yields, nominal and real. Yields reflect the market's expectations for growth, inflation, and policy. What matters is not the headline level, but direction and consistency. Rising real yields tend to increase opportunity cost. Falling or stable real yields often reduce pressure on non-yielding assets. Divergences between yields and price behavior can be especially informative after sharp moves. 3. Inflation data, CPI and PCE. Upcoming inflation releases are important, not because of the number itself, but because of how markets react to it. Key questions. Does the data change expectations or confirm what's already priced in? Do markets move decisively or fade the reaction? Muted reactions often signal stabilization. Violent reactions suggest unresolved positioning. 4. Volume, liquidity, and market depth. After fast repricing events, I watch whether volume declines as volatility compresses. Bid-ask spreads normalize. Price moves require more effort to extend. These are signs of structural repair in the market. 5. Open interest and positioning. Changes in open interest help distinguish between new positions entering the market, existing positions being closed or reduced. Falling open interest during volatility often indicates deleveraging, which can reduce future instability once complete. Why these matter? None of these indicators provide certainty. Together, they provide context. They help answer a simple question. Is the market still under pressure, or is it absorbing the shock? That distinction determines everything that follows. Sharp market moves tend to expose emotion before they reveal information. What happened recently doesn't demand urgency, it demands clarity. Markets regularly move faster than narratives can explain. That doesn't make those moves mysterious or alarming. It simply reflects how modern markets process risk, liquidity, and expectations in real time. The most important takeaway isn't where prices went today. It's how quickly conditions can change when positioning becomes crowded and assumptions go unchallenged. This isn't investment advice. It's simply how I'm reading the market right now. Periods like this reward discipline more than decisiveness, patience more than prediction, and process more than conviction. Risk management matters. Time horizon matters. Understanding structure matters. Short-term volatility doesn't invalidate long-term thinking, but it does test it. The goal isn't to react to every move. It's to stay positioned to make rational decisions when clarity returns. And clarity always returns, quietly long after the noise fades.